wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest development in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 216, and in this episode we're reviewing the performance of the financial markets during the 23rd week of 2026, and that is from Monday the 8th to Friday the 12th of June. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where inflation accelerated in May as rising energy costs contributed to pain for consumers, though underlying pressures were less intense. The Consumer Price Index, which is a broad gauge for goods and service costs across the U.S. economy, rose at a seasonally adjusted pace of 0.5% for the month, putting the annual rate of inflation at 4.2%, and this is according to the Bureau of Labor Statistics that reported this data on Wednesday. Both numbers were in line with the Dow Jones consensus estimate, though the monthly number was 0.1 percentage points below the April reading. Inflation climbed above 4% for the first time in 3 years, though the increase met expectations amid concerns over how much the surge in energy prices would impact the economy. This level of inflation was the highest since April 2023 and was above the 3.8% reading for the month of April. However, stripping out volatile food and energy prices, the so-called core consumer price index accelerated by 0.2% for the month and by 2.9% on an annual basis. Whilst the annual rate was in line with the forecast, the monthly gain was below the 0.3% estimate and less than the 0.4% increase in April. And in related news, wholesale prices rose more than expected in May, indicating that pipeline inflationary pressures are percolating higher, and that again is data based from the Bureau of Labor Statistics that was reported on Thursday. The Producer Price Index, which is a measure of final demand cost, increased at a seasonally adjusted pace of 1.1%, putting the annual headline wholesale rate of inflation at 6.5%, which was the highest rate since November 2022. Meanwhile, minutes of the Fed's last policy meeting that was held on April 28th and 29th were published last week and showed a growing number of officials were open to the possibility that they may need to raise interest rates in the near term. And over to the Eurozone, where the European Central Bank announced a quarter-point rate hike on Thursday, bringing its key interest rate to 2.25%, as the Iran war continues to blow inflation off target. According to LSEG data, markets had been pricing in a nearly 100% chance that the ECB would raise interest rates by at least 25 basis points ahead of its June Governing Council meeting. The ECB's Governing Council said that the decision had been made in a bid to ward off inflationary pressures generated by the US-Iran war. The central bank also raised its inflation forecast, saying it now expects headline inflation in the Eurozone to average around 3% in 2026 before cooling off to 2.3% next year and falling to 2% in 2028. Meanwhile, economic growth forecasts were revised downwards for this year, with the ECB now expecting growth in the Eurozone to average at 0.8% in 2026 and at 1.2% in 2027. Moving over to China. China's wholesale prices rose at the fastest pace in nearly 4 years in the month of May, driven by surging oil prices due to the Iran war, while consumer inflation came in below estimates. The producer price index jumped by 3.9% from a year ago, which was the highest level since July 2022, topping economists' forecast of 3.8% and outpacing the rate of 2.8% in April, and this is according to data released by the National Bureau of Statistics on Wednesday. Meanwhile, consumer prices rose by 1.2% in the month of May, and this is compared to a year ago, missing economists' estimate for an increase of 1.3%. And over to the United Kingdom, where figures published on Friday showed that the UK economy shrunk by 0.1% in the month to April, and this was in line with market expectations as the impact of the Iran war continues to hamper economic growth. A 0.2% contraction in services activity was cited as the main driver of negative growth, with officials saying it was partly offset by a 0.1% rise in construction output. While production output showed zero growth for the month, April's contraction of 0.1% followed a growth of 0.3% in March and a 0.4% in February, whilst January recorded no growth at all. On Wall Street last week, stocks rose on Friday as SpaceX's opening pop bolstered sentiment, with investors hoping for the arrival of a potential peace deal between the US and Iran. Elon Musk's rocket maker debuted on the Nasdaq at $150 per share, and this was above the IPO price of $135. The stock soared more than 20% shortly after it opened for trade and closed up 19% at around $161. The run-up in SpaceX boosted investor confidence, leading some on Wall Street to believe that other stocks may be undervalued. The tech trade was mixed on the day, but had been ramping up recently on hopes for a successful debut for SpaceX, which is also an artificial intelligence appetite proxy because of its XAI unit. The S&P 500 closed up 0.5% at 7,431, whilst the Nasdaq added 0.31% to finish at 25,888, and the Dow Jones Industrial Average advanced by 353 points to settle at 51,202. And in related news, With SpaceX opening at the Nasdaq at $150 a share on Friday, the CEO of SpaceX and Tesla now has a stake in SpaceX that's worth more than $766 billion. Combined with his Tesla stake, which is worth $280 billion, Musk's net worth from both companies as of Friday was estimated at roughly $1.05 trillion. Shares of SpaceX gained roughly 20% on Friday to close just above $160 apiece, and this values the company at more than $2 trillion. In the government bond market, U.S. Treasury yields edged higher on Friday after falling sharply the previous session, while oil prices fell as traders monitored the prospect of a resolution to the Middle East conflict. The prospect of a peace deal also pulled energy prices sharply lower and sent global bond yields tumbling. The reversal in U.S. Treasury yields comes as investors digested a higher-than-expected rise in May's Producer Price Index, a key indicator of wholesale inflation. The yield on the 10-year Treasury bond, which is the main benchmark for mortgages, auto loans, and credit cards, was up by more than 1 basis point at 4.48%, whilst the yield on the 2-year Treasury note, which typically moves in line with short-term Federal Reserve interest rate decisions, rose more than 1 basis point to settle at 4.08%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, oil prices fell on Friday as the U.S. and Iran neared an agreement to reopen the Strait of Hormuz, though the outcome was still not certain. A senior official in the Trump administration said that they see an 80% chance that the U.S. and Iran will sign an agreement in the coming days. The proposed peace deal would reopen the Strait of Hormuz and lift the U.S. naval blockade, as well as dismantle Iran's nuclear program and remove its enriched uranium. Iran would also receive financial incentives to assist with reconstruction if they comply with this agreement. Oil prices lost about 6% this past week, though they're still up more than 20% since the war began on the 28th of February, and U.S. crude, that is West Texas Intermediate, fell by 3.2% on Friday to close at $84.88 per barrel, whilst the international benchmark Brent crude lost about 3.4% to finally settle at $87.33 per barrel. And in the precious metals market, gold was headed for a second straight weekly loss on Friday as expectations of higher interest rates weighed on the non-yielding metal ahead of next week's Federal Reserve policy meeting. Gold has been under pressure since the war began at the end of February on concerns that oil-driven inflation means that central banks will keep interest rates elevated for much longer than initially expected. Inflation is expected to linger for a little while longer, even if oil prices come down in the near term. According to the CME's Fed Watch tool, traders are pricing in a 57% chance that the Federal Reserve will hike interest rates by December this year. While investors regard gold as an inflation hedge, higher rates tend to weigh down on the non-yielding metal. The price of spot gold was down by 2.4% for the week and closed at $4,225 per ounce. And in the African financial markets this past week, South Africa's economy expanded more than expected in the first quarter of 2026, with output growing in nearly all sectors, though the statistics agencies said that the impact of the Iran war was likely to show up in the second quarter. Statistics South Africa data showed that the gross domestic product grew by 0.5% on a quarter-on-quarter basis in the first 3 months of 2026. Economists polled by Reuters had forecast GDP growth of 0.3% compared to an increase of 0.4% in the last quarter of 2025. Africa's largest economies started to pick up pace in 2025 and investor sentiment brightened on signs of fiscal discipline. However, the Iran war has dampened the near-term outlook. And over to Nigeria, where according to sources and a placement document, the Dangote petroleum refinery is seeking to raise about $1 billion through a private placement that values the company at approximately $39.1 billion. For this private placement, which is a method of raising capital where a company sells shares directly to a select group of accredited investors, the Dangote refinery is offering 3 billion ordinary shares at 35 US cents per share, with investor demand already exceeding $2 billion. Investors must subscribe for a minimum of 1 million shares with a total cost of $350,000, with additional purchases in multiples of 500,000 shares. Shares will be subject to a lock-up period of 365 days. The placement document showed that proceeds of the private placement will be used for expansion and general corporate purposes as the refinery ramps up operations and strengthens its market position. We now change scene to the Kenyan financial market, and we start by looking at the central bank's latest policy decision, where the Monetary Policy Committee maintained the central bank rate at 8.75% during its policy meeting held on Tuesday, the 9th of June. The committee observed that the conflict in the Middle East has disrupted global supply chains, leading to significantly higher energy prices. And as a result, Kenya's overall rate of inflation rose to 6.7% in May, up from 5.6% in April, and is expected to remain within the target range in the near term. Central banks in the major economies, except the European Central Bank, kept their policy rates unchanged as they assess the impact of the conflict in the Middle East on their inflation and growth outlooks. The committee also observed that average lending rates in the domestic market have continued to decline, whilst private sector credit growth has continued to improve. The committee concluded that the current monetary policy stance, with the central bank rate remaining unchanged at 8.75%, was appropriate to ensure that inflation expectations remain well anchored and also to ensure that the exchange rate remains stable. And over to the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade broadly sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.37 compared to a rate of 129.52 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.71 and the euro was valued at 150.11. And on the regional front, one Kenyan shilling was changing hands for 29.10 Ugandan shillings and 20.30 Tanzanian shillings, and to the Rwandese franc, it it was posted at 11.31. Despite the war against Iran and the subsequent increase in oil prices, the Kenya shilling continues to remain extremely stable versus the US dollar. The data shows that the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $39 million for a grand total of $13.24 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. But despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market remained liquid and well-funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, these averaged at around 17.9 billion shillings. And just for your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 11th of June, and the central bank received bids totaling to 39.3 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 164%. The central bank accepted 32.6 billion shillings, and the results of the auction were as follows. The 91-day rate shot up by about 15 basis points to settle at 8.70%, whilst the 182-day rate followed trend with an increase of 7.5 basis points to close at 8.60%, and the 364-day rate inched up by more than 10 basis points to average out at 8.87%. Over the past few weeks, the yield on the short end of the Treasury bill market has been rising steadily, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. And in addition to this, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. As a result, we should therefore expect more upward pressure on interest rates as investors pack their funds into the 91-day Treasury bill, which gives them the opportunity to invest at a higher rate in the short term. In the primary bond market, the Central Bank of Kenya announced a top sale for the two reopened fixed coupon Treasury bonds, in which it was looking to raise an additional amount of 15 billion shillings. The auction for the top sale was held on Monday, the 8th of June, and the central bank received bids totaling to 8.7 billion shillings against an advertised amount of 15 billion shillings, representing a performance rate of about 58%. The central bank accepted 8.4 billion shillings, and the results of the auction were as follows. For the first bond, which was a 15-year bond that was initially issued in 2020 and now has 8.7 years left to maturity, the central bank accepted 5.9 billion shillings at a weighted average rate of 13.31%. This bond matures in February 2035 and has a coupon rate of 12.75%. And for the second bond, which is a 25-year bond that was initially issued in 2018 and now has 17.1 years left to maturity, the central bank accepted 2.49 billion shillings at a weighted average rate of 14.23%. This bond matures in May 2043 and has a coupon rate of 13.40%. Staying in the primary bond market, the Central Bank of Kenya published a prospectus and is inviting bids for the reopening of another two fixed coupon Treasury bonds, in which it is looking to raise a total of 60 billion shillings, and the terms and conditions of these two bonds are as follows. The first bond is a 20-year bond that was initially issued in 2018 and now has 11.8 years left to maturity. This bond matures in March 2038 and has a coupon rate of 13.20%. And for the second bond, this is a 25-year bond that was initially issued in 2021 and now has 20 years left to maturity. This bond matures in April 2046 and has a coupon rate of 13.92%. These bonds are now open for sale until Wednesday, the 17th of June, when the auction will be held. Up next is our topical issue, and this week we're looking at the Treasury's proposal to extend the minimum core capital requirement for banks by 3 years. The National Treasury has proposed an extension of 3 years to allow commercial banks more time to comply with the minimum core capital requirement of 10 billion shillings, effectively pushing the deadline from December 2029 to December 2032. The Treasury Cabinet Secretary announced this major shift during the 2026-2027 budget reading on Thursday. This decision directly challenges the earlier and stricter stance maintained by the Central Bank of Kenya, which had repeatedly refused to grant an extension to struggling commercial banks. Financial disclosures for the quarter ended 31st of March 2026 showed that Credit Bank, Consolidated Bank of Kenya, Development Bank of Kenya, and Access Bank Kenya had core capital of below 3 billion shillings, putting them in breach of regulatory requirements. Under the Business Laws Amendment Act of 2024, banks were required to raise their minimum core capital from 1 billion shillings to 3 billion shillings by the end of December 2025. The law had also required lenders to adopt a phased approach to increasing their minimum core capital, raising it to 5 billion shillings by the end of 2026 and increasing this gradually to 10 billion shillings by the end of 2029. And in addition to extending the deadline, the Treasury Cabinet Secretary also cancelled this phased approach to raising the core capital, which means that struggling commercial banks now have only one major target to achieve by December 2032. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuriji@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, success usually comes to those who are too busy to be looking for it. A quote by Henry David Thoreau. Think about it. Thank you, and God bless.